let's move to our financial model. Means we already have a financial model with the 3 statement which we covered in our last 3 sessions last week. So on the basis of that, we will value the company. First of all, we will go with the free cash flow to firm, how to calculate the free cash flow to firm, and then we will move to free cash flow to equity. A weighted average cost of capital. So means our WACC. First, we will calculate our WACC, means how to calculate the WACC. Like our WACC main thing was, let me zoom. First, we calculate our beta. For the beta, we have 2 methods to get the beta. There is one of the source that we can get the industry beta from 𝗪𝗏𝗏𝗘𝗟. It's a reliable source. And then the other method is that we get the beta of our comparable companies within the same sector. So on the basis of that, we get the weighted average beta for those companies. We unlevered it, and then on the base of our own debt to equity ratio, we levered our company beta. So our beta formula is means unlevered beta into 1 plus 1 minus tax rate into debt to equity ratio. Why tax rate? The tax rate means we need to get the tax yield net of tax. For the cost of equity, we have a risk-free rate. As this moment we are discussing the Saudi company, Saudi based, so we are taking the Saudi 𝗪𝗏𝗏 beta. So means we have a source added to that, and on the base of that, we take the tax yield for those companies. And then we have a equity risk premium. Equity risk premium is a country default risk and risk premium by 𝗪𝗏𝗏𝗘𝗟. Then we have our levered beta size premium. So in the CAPM method, it's only introduced the risk-free rate plus equity risk premium. But there are other risk factors that we need to consider in our company on the base of the company size. So we have a company size premium by Duff and Phillips. So I will share this source as well with you. So means how we need to get that on the basis of the size of the company. Then there is one more. It's a company specific risk premium. So this is purely on professional judgment. So once you are doing the valuing the company, you did the forecast of the fully company, you discuss with the management, then you analyze that how management taking care of their business, or their financials are properly managed, or they are professional, or their operations are smooth, or there is any risk in the business. So we apply that alpha factor, company risk premium as well into that. So on the base of that, we get our cost of equity, means our cost of equity. So then to reach on the WACC, we need to get the percentage of debt or equity in our business. So at this moment, our company have 100% because this is a startup phase project. So we have a 50% debt and 50% equity. Cost of debt is our interbank rate plus credit spread for the Saudi market. We have a cost of equity and tax. Then on the base of that means by giving the weight to both. So we have our WACC for the business. Then we have a terminal growth rate for the KSA. We take it from the IMF website, which give us the inflation rate or terminal growth rate for every country. So we taken the long-term growth rate. Then we have a discount for discounts and control premium. Discount for lack of marketability, as I discussed that we need to discount the company. So there is a different ranges from 15% to 20% applicable on the companies. So means in a different session we can let you know that how we calculate these sources, these discounts as well. So control premium is from the business valuation resource. We have taken that because we are in the manufacturing industry. So we have taken the control premium for the manufacturing industry, and then on the base of that control premium, we calculate the discount of lack of control. If we calculate the X percentage of the company value, means like less than 50%, so we will apply the discount for lack of control on that value as well. For zakat and tax rate, we have a shareholding of the company, like company have a 70% foreign shareholding and 30% local shareholding. As in Saudi Arabia, on a local shareholding we have a 2.5% zakat, and on the foreign shareholding we have a 20% tax. So we get the effective tax or zakat rate. Okay, so now up to this, everyone clear? Means how to calculate the WACC. Yeah. Can you turn on your mic and yeah, what's it? Effective tax rate means like, for example, here we have a company, there is a different shareholding percentage, like 7.8% we calculated that. Let me local shareholding and foreign shareholding or expat shareholding. This is specifically for the Saudi Arabia. We are discussing at this moment for Saudi region. Zakat rate and tax rate. For example, 30% local shareholding, 70% foreign shareholding, and 2.5% zakat and 20% tax. So we need to calculate our effective tax rate. So effective tax rate will be okay. So means this can be our effective tax rate. Okay. So this is depends on the company, means how much company we are we are discussing that. At this moment, this is the 7.8 for this company. So means it change company to company, but this is for specifically for the Saudi Arabia. For other country, we will follow their country rules. Will not this is the zakat and tax rule. Okay. Now we covered our weighted average cost of method. We calculate our WACC. Now we'll go to free cash flow to firm. That how to calculate the free cash flow to firm. Like in the free cash flow to we in our calculation we discussed that how we have to calculate this. Now just for revenue, because as we in our discussion I did not edit that means revenue will be the part of that, but just for the clarity, means we see that how company works, means if we need to see the bottom line number, we need to have a look on our top line numbers as well. So here revenue, so now we will link one by one item into our financial statement, 3-statement financial model, which we already prepared. If you don't have any question, please turn off your mic, please. Okay, so we will link items one by one into our financial statement. So revenue is our top line item. So we are going to link it with our financials. Okay, and then EBIT, earning before interest and tax. It's also from our income statement. Zakat and tax rate, we already calculated our zakat and tax rate in our weighted average cost of method, effective tax and zakat rate. So we have this one. Then we calculate net operating profit after tax. The tax or zakat calculated in the financial statement, where we are not taking that, because at this moment we are going with the FCFF. So if we take that zakat, it will have an impact of finance cost as well. So here we are going from the EBIT, interest earning before interest and tax, and then we will make it NOPAT, net operating profit after tax. So here by calculating this, we need to consider one thing, like if our EBIT is negative, income is negative, so why we have to calculate the zakat? So we need to apply the conditions on this. If our net income is greater than 0, the result will be our net income multiplied by tax rate, otherwise 0. We have calculated our net operating profit after tax. Then we have a line item from our cash flows, means the line item which we need to add back into our non-cash items, and then our changes in the working capital. So we have our in our cash flow. So let's go to our cash flow. In our cash flow, we have a depreciation and amortization. Depreciation added back. Then we have a changes in our working capital. The changes in working capital. And by summing up all these, we have our cash flow from operations. Okay. Clear? So we have calculated our cash flow from operation. Then we need to deduct any kind of capex which we are incurring on a year-on basis or on the startup phase of the business, which is also from our cash flow from the investing activities. In this business, we have two types of our cash flows, which is our pre-operating expenses and our capex, because this is the greenfield project. So we did that. So by summing up all these free cash flow from operations plus minus these capex, so we have our cash flow, free cash flow to firm. After this clear, means we have calculated our FCFF by using our three statement function. Any questions? Okay. So just for NOPAT, yeah, multiplication is 1 minus. Yeah. It should be 1 minus. Yeah, it should be 1 minus. Right. Good catch. To 1 minus. Right. Okay. So we have our NOPAT and then we have our free cash flow to firm. Discrete period. So this is our period, means we are operating, means year to year. Like our first year of operations is always 0 because this is a free, startup phase. If it's not a startup phase, then we will give it a number, means it's a year, first year or second year. So it's a year 0 for the startup phase. So the next periods. So these are our total 9, means in total 10 years, but we have a construction phase plus our operation phase. Then discount factor. Like we are in the FCFF, so which discount rate we will apply? WACC. Okay. So to apply the WACC, what will be our formula? Anyone let me know the formula for the WACC? Any WACC, we already have a WACC. So means to calculate the discount rate. Yeah, question means how to calculate discount factor on the base by using the WACC. 1 plus R means our rate, WACC raised to power minus number of years, means in which year we are. So we get our WACC. Okay, it's clear. So then we will discount our free cash flow to firm multiplied by discount rate. So we get our present value of FCFF. So now we will get the net present value of FCFF, which will be the sum of all our free cash flow present value. The next step is we have to calculate our present value of terminal value. There is two ways to calculate that. Either we use the simple one formula, that free cash flow of the last year into 1 plus growth rate, which is our terminal value, divided by our WACC minus growth rate. Okay, we have calculated our terminal value. Is this correct? I think this is not correct. Okay, we will check that. Okay, so means there is a one way that we by using the method we calculate our terminal value for by summing means within one formula. But here I have a breakdown that how to calculate the free cash flow to the form value of the company. Yes, it was we missed one thing, like this is the, because we taken the FCFF, not the present value of the FCFF. Why you are thinking that why it's too high? So means we need to apply the discount rate on this as well. Means what for that year, in which year we calculated our terminal value. So this is our discount rate. So now this we get our value of the business, means like our terminal value. Okay, so the other way is that if we break down into the step by step, instead of keeping a one formula, we calculate step by step free cash flow to firm. Then we have a terminal growth rate. So means we need to make it easier for user to understand. So means this is 1 plus our growth rate. So we have a forward looking FCFF. So because we are in the FCFF, so this is forward looking FCFF. Then we have WACC. We already calculated our WACC. Okay. Capitalization rate. For the capitalization rate is equal to WACC minus growth. So now we can have our terminal value. Terminal value will be okay. So in the both method we will get our same terminal value, but just here we just break down into our into steps this terminal value into discount factor. So we will have a present value. So we will add it into our present value FCFF. So now we get net present value of FCFF plus terminal value, present value of terminal value. We have a enterprise value of the business. The equity value. To reach on the equity value, we need to take the debt of the company, means at the start of the period, means what is our valuation date. So at that date we need to calculate the see what is our debt of the business. So as this is the startup phase business, so in that we are taking a 50% debt for the capital expenditure. So that amount will be our debt for this one. Debt, add cash in the startup phase, either we have a cash or not, because we are starting our project. It's a zero, means at this moment we're just raising the money for the capex and for the operating expense. So it means we will not have any cash. If we are doing the valuation of the running business, then we will take the cash of the last period, means like for example if we are calculating the value at 31st December 2025, so we will take the closing balance cash of the 2025 and we will take the debt for that period as well. Clear? So at this moment we don't have cash, so it's our market. We get the equity value marketable and controlling, as I already explained in our previous means slides, that what valuation we will get at each step. So means once we get enterprise value minus debt, add cash, so we get our equity value marketable and controlling. Here, so then as this moment if we are in a private company, we are doing a private company valuation, so we need to apply the discounts for the discount for lack of marketability. So we already discussed our discount for lack of marketability. In this case is 20.7%. So our valuation will be equity value multiplied by 1 minus discount rate. So we have a valuation of 98 million through FCFF method. Clear? So means we discuss our how to link it with the financial statement, how to calculate the discount rate, how to calculate the present value of the free cash flows, and then how to calculate our terminal value. So ultimately we get our one valuation through FCFF method. So this gives us a 90 million valuation for the full company. Anyone have a question up to this? All clear? Okay. Now we will move to our second method. Our second method, free cash flow to equity. How to calculate free cash flow to equity? Free cash flow formula is FCFF minus finance cost net of tax minus net debt. So we will get our FCFE. This is the one way, means we already calculate our FCFF in the above schedule, and now we can calculate that FCFE. This is the one method. So in the both methods we will get the value, same value. Now, but here I will go step by step because our stakeholders will be different. Like for the FCFF we can present it to, we need to present it to, maybe we need to present it to different, and for the FCFE we need to present to the shareholders or different stakeholders. So we will give the complete breakdown of that FCFE as well. So same pattern, we will link all the things in our income statement. So for this I already anchored, or you see I already anchored our line items, means which is coming from our financial statements. So we can just copy and paste those to our up to our capex and pre-operating items. So means just a quick, means we already have one schedule, we anchor these things, just need to copy and paste. We go with the free cash flow to firm. Our free cash flow to firm, same as above, just a quick check, this minus this, so 0, means our FCFF is correct. Now the next adjustments are finance cost and debt. So the finance cost we are charging in our business, we need to deduct into that, because to our shareholders we need a amount which is pertain to that shareholders, means by paying all kind of debt, all kind of financing cost. So in our FS we have our finance cost into 1 minus tax. So means this will be a net of tax benefit, means we will have the benefit of the tax in that. So we will have a net of tax amount. So tax we already have this one, either we can take from this, or either we can take from this one. Clear? Then we have a net debt. So means net debt. What is our net debt? Means how we link it with our financials. Yeah, from the free cash flow statement is the movement of the debt in that certain year, means in that year. Within the year, what is the movement? Means debt drawdown minus repayment. So means we will have a net debt for the period. So we already have our debt in our cash flow statement. Means in the starting year we have a drawdowns, and then we have a repayments. So by adjusting these two items, we have our FCFE, free cash flow to equity. Then same, we will apply the discrete our period, and then discount factor. For this, which what will be our discount factor? Cost of, yeah, means we are calculating the value of equity, so we will take our cost of equity. Yeah, sorry. Yeah, we need to anchor E. We can fully anchor it. Okay. So now we have our discount rate, FCFE multiplied by discount rate. We have our present value of FCFE. So will be same like FCFF. We will get net present value of FCFE, which is 30 million. Now present value of terminal value. Same method, same way we can calculate in the both way, either in a one formula, either in the other formula. Just the difference will be here we will take free cash flow to equity last year cash flow for the equity holders, and we will apply the discount rate for the cost of equity, we will not use the WACC, only use the cost of equity. So let's do it step by step. So here free cash flow to equity. This is our free cash flow to equity. Free cash flow to equity for the last year. Then terminal growth rate, same for all methods. So we have a forward-looking FCFE. Then we have a cost of equity. We already calculated cost of equity. Then capitalization rate. Capitalization rate, cost of equity minus growth rate. Terminal value will be forward-looking FCFE divided by our capitalization rate. Okay. So here we need to apply the same discount rate for that year. We already calculated. Okay. So here we go with the terminal value. We have a terminal value of our FCFE. We'll link it with our valuation. So here there is a one difference in this method and FCFF. Like for this method, we will not get the enterprise value. We will directly get the equity value because we already deducted that, means we already net off the, now whatever the amount pertains in that, it's the value of the shareholder. So it will not be the enterprise value, it will be the equity value. So means we will get the equity value. Then we have same method, we will apply the DLOM, discount for lack of marketability. Means we are going parallel with the whatever we applied in the first method, the second method will be same. So our equity value into 1 minus. Okay. So now we have equity value. So here we can add both values. We can say that marketable MNC are NM and C. So means we can, for the reader, we can give all kind of valuation to him. So means he can see, understand that what's going on with the valuation, and this will be our equity value through this one. Okay, and then for FCFF, this is our valuation. So like our for marketable and controlling, we have 123 million for the FCFF and 98 million for the for the non-marketable and controlling. For the FCFE, 77 million for marketable and controlling, and 61 million after applying the discount for lack of marketability. All clear? Up to this means any issue? We have calculated our FCFF method and our FCFE. So normal practice, we do this. Means we calculated our FCFF method. I have one question. FCFF and FCFE valuation through both methods, it needs to be same or it needs to be different? Loud. Why it needs to be different? Okay.
But for the equity thing,
Mm-hmm.
equity, like we are calculating the equity value.
Yeah.
For both method, FCFF and FCFE, we are finding the equity value.
One value. We are calculating one value. Means like for the both methods at the end gives us equity value. So means if there is a gap in our both methods valuation, so it means there is something wrong. There is something wrong which we need to cover. Because both methods gives us the equity value of the company to shareholders. So why it's a gap? So means if we give the value through the FCFF, so if shareholder says that 123 million, we have a valuation of 123 and FCF is 77, so they will be disturbed with this. Means why this is, so means they will assume the valuation of the company 123 million, but the actual value is showing as 77 million. So we need to cover that gap. Why there is a gap? Anyone have idea about this? Anyone? No. Yeah. Yet discount factor, if either we use the WACC, either we use cost of equity, because for the cost of equity we use the FCFE, so it suggested that. For the WACC we used WACC, for the FCFF, so it suggested that risk. So this one cover.